Last week, global markets were shaped less by optimism and more by political risk, policy uncertainty, and cautious recalibration. In the United States, attention returned to trade tensions. President Trump's renewed tariff threats toward European partners triggered volatility across global equities, particularly in European markets. International institutions warned that escalating trade pressure could weigh on global growth if rhetoric turns into policy. At the same time, investors remained focused on the future direction of the Federal Reserve. While interest rates were widely expected to remain unchanged, political pressure surrounding the Fed's leadership added a new layer of uncertainty. Markets began pricing a longer period of restrictive monetary conditions. Corporate earnings season quietly moved into focus. Technology companies drew particular attention, as investors looked for confirmation that earnings growth can justify elevated valuations in a high-rate environment. In Europe, economic data continued to signal weakness, manufacturing activity remained under pressure, and policymakers faced the challenge of supporting growth without reigniting inflation. Meanwhile, in global trade, there was a rare constructive signal. Negotiations for a free trade agreement between India and the European Union approached their final stage, offering a counterbalance to rising protectionist sentiment elsewhere. Across asset classes, oil prices fluctuated on geopolitical uncertainty, while gold held firm as investors sought stability. Taken together, the past week delivered a clear message. Markets are no longer driven by momentum, but by risk assessment. This is not a moment for speezing. It is a moment for positioning, discipline, and selective conviction.